Thank you, Anna.
Well, top of your agenda this morning that you wanted to talk about is this issue that is under discussion right now, pension funds into government, and what could happen if we did get a prescription of how much should be invested into fixed interest and particularly into government projects.
It's a very contentious issue. It's very political, and I'll probably avoid that dimension of the discussion. But the reality is that of the very, very significant current savings pool, pension savings pool, already 20% of it is in instruments that fund both government and infrastructure development. So many years ago, there were what they call prescribed investments, and prescription is an ugly word. It's sort of you will, not you should or you could, you must. What these things are is a way to attract funding at reasonably low prices from a captive audience being national savings or pension savings. The two biggest funds there are the Public Investment Commissioner and the Government Employees Pension Fund, who already have very material savings allocations to bonds and debt instruments of parastatals. So really the kind of the trick there is that if you take more of assets that already have a guideline, the pensions industry has already said it's prudent not to have 100% of your money invested into risky assets like equities and properties, but that you should have around 20 or 25% of the funds into safe investments.
And your problem with it more than anything is the nature of fixed interest, if that were a prescription.
Well, the danger is that if those levels are structured at lower than reasonable or lower than inflation or close to inflation, after the charges that will occur in the management of and the administration of a fund, your net return is going to be negative to inflation, which means how the hell do you pay your pensioners?
You were saying that this is going to more than anything have effect at institutional level. So let's talk about those institutions. If they were given this as a proposal, what do you think their reaction would be?
Probably they'd have to be more politically sensitive than I might have to be as an individual, but it's not a good idea because you're starting to dictate to people that a high percentage, I think probably 25 years back, I remember prudential or other prescribed investments being of the order of 40%. Now, if 4 Rand out of 10 or 400,000 out of a million or 400 million out of a billion is invested into something that's going to give you suboptimal returns, you might be, acting in a way which arguably is irresponsible for the long-term outcome of your investor pool, which is, and I guess the government's caught between a rock and a hard place here, in as much as they are trying to give you, trying to make savings and improve the South African savings culture, and in doing so, obviate the necessity for them to look after people in their retirement. But by the introduction of something like this, which might make short-term funding sense, you have a counterproductive impact long-term.
Let's talk about something that is in discussion right now. I was talking earlier on about, the governor's speech on Saturday, and how she was talking about monetary policy. And I went through the speech, and a lot of that speech still focused on what's happening in Europe, and she was saying it's a mistake right now to think that the Europe crisis is over, and you were saying that you actually agree with her sentiments there.
I absolutely do. I think that there was a great saying coined in the crunch, or just after the crunch, and that was kicking the tin down the road, is kind of almost pushing out the date of Armageddon. Now, I don't think we're in Armageddon territory, but the greatest risk is that, and the political pressure on the European major countries and economies to sort out the lesser economies was probably to avoid the rollover of this problem into other places that are similarly compromised, with better than Greece, less than Greece probabilities of getting out of the hole that they've dug themselves and has been dug for them by the introduction of these fancy structures and debt instruments and derivatives and so forth. But what about South America? Certain parts of South America are severely compromised. They're not Brazil, they're not Argentina. They are smaller, much more vulnerable, in a poor shape, and they could be next on the funeral pile.
Mike, I have to ask this before you go very, very quickly. I've been told that our interview should actually end now because we've run out of time, but where are you investing right now? Where are you seeing opportunity?
I think that we remain deployed across asset classes. We remain deployed across geographies. We are very, very cautious. We probably err on the cautious as an investment house. We use multi-managers overseas. We use passive investments overseas. I do think the international equity markets represent good value. If you look at the local unit trust managers, they're all upping the game and their exposure to non-South African assets, which I think right now is prudent because we've had such a good run.
Thank you so much for joining us, Mike Estment, and he's CEO of NFB.